The market is currently closed, and the final closing price on September 4, 2025 was 24.49, down from the previous close. The most striking element of SoFi's recent trajectory isn't just the price action, which has seen some dramatic swings, but the intense and almost schizophrenic divergence between what the market expects and what the company is actually doing. While the price has been rocketing upwards, nearly quadrupling over the past year, a closer look at the analyst consensus and internal trading activity reveals a deep-seated skepticism that is often masked by the retail-driven momentum. The common narrative is that SoFi is the quintessential fintech growth story, a disruptive force poised to take over traditional banking, and the price rally seems to confirm this. But the reality is far more complex. A tension between a business that is demonstrably executing on its strategic goals and a market that is not fully convinced of its long-term profitability and valuation. To truly understand this dynamic, you have to dissect the recent trading history. We've seen periods of explosive growth, like the rally in late August, where the stock surged following a robust Q2 earnings report. Adjusted net revenue jumped 44% year over year, and management raised full-year guidance, a clear signal that the company is on the right track. This sparked a wave of analyst upgrades and fueled retail buying frenzy, pushing the stock to multi-year highs near the 26 mark. But what happened immediately after? A sharp correction. This wasn't a profit-taking event driven by a slight wobble. It was a significant pullback, with the stock dropping over 4% in a single day as institutional investors and traders took caution, highlighting a fundamental skepticism about the valuation at those levels. This pattern is telling. The initial emotional reaction to good news is a massive buy-in, but the cooler, more deliberate money seems to be operating with a different calculus, selling into strength because they see the stock as overvalued relative to its peers and its long-term fundamentals. The core of the market's ambivalence lies in the delicate balancing act SoFi is performing. On one hand, the company is a spectacular growth story. They are rapidly acquiring new members and cross-selling a diverse range of products. Their Q2 results showed a staggering increase in revenue, and their forward guidance is optimistic. The company has made significant strides in achieving GAAP profitability, a milestone that had long been a major concern for investors. On the other hand, the valuation metrics are astronomical. The stock is trading at a P/E ratio over 50, a significant premium to many of its financial sector peers. While a high P/E is often justified by a company's growth prospects, the market is questioning whether SoFi can sustain this level of growth to justify its current price. This is where the tension lies, the promise of future growth versus the reality of today's financial metrics. The bearish view, which is becoming increasingly vocal, points to potential credit weaknesses if the economy slows down and pressures on the net interest margin. 2. The stock's performance on days with broader macroeconomic jitters, like those following hawkish Fed minutes, demonstrates its sensitivity to these risks. Traders are quick to sell off SoFi in a risk-off environment, even after a string of positive company-specific news. This suggests that for all the retail enthusiasm, the institutional money sees SoFi as a high-beta play on the fintech sector, and a potential casualty if the economic narrative shifts. SoFi's business model is a critical element of this analysis. At its heart, SoFi is a digital-first financial services platform. 3. It's not just a lender. It's a one-stop shop for personal finance. They started with student loan refinancing, a business that faced headwinds from the student loan moratorium but have since diversified aggressively. They now offer personal loans, home loans, and a full suite of banking services including checking and savings accounts. They also have an investing platform and a technology platform, Galileo, that powers other fintech companies. This diversification is a major strength, insulating them from downturns in any single business segment. For instance, while the student loan business was on pause, their personal loan and Galileo segments flourished. This is what gives the company its long-term potential and is the basis for the bull case. They are building a genuine financial ecosystem that can capture a user's entire financial life, from student to homeowner. However, this diversification also presents challenges. The competition is fierce, not only from traditional banks but also from other fintech giants. 4. Customer acquisition costs are high, and the company has to continually invest in technology and marketing to stay ahead. 5. The market, particularly the more cynical institutional players, is watching closely to see if SoFi can not only grow its user base but also convert that growth into sustainable, long-term profitability. without significant shareholder dilution from stock-based compensation. The recent flurry of insider and institutional activity is another data point that challenges the simplistic SoFi is a rocket ship narrative. While retail investors have been buying, there have been reports of key executives selling off shares and a mixed bag of institutional ownership changes. A CEO selling a portion of their holdings is not necessarily a sign of a lack of confidence it can be for personal financial planning. But when combined with the fact that several institutions are holding a neutral hold rating, it adds to the sense of caution. The average analyst price target is significantly below the current trading price, with some estimates in the low teens, indicating a broad belief that the stock is fundamentally overvalued. Number 6. This creates a fascinating and dangerous dynamic. Retail traders are fueling the momentum, while professional analysts and some institutions are essentially betting on a price correction. This is the definition of a high-tension trade, a significant divergence between public perception and expert analysis. Moving forward, the key catalyst to watch will be the company's ability to continue to grow its deposits and its Galileo platform. Deposit growth is critical because it lowers their cost of capital, making their lending business more profitable and less reliant on external funding. The Galileo platform is their secret weapon. It is a high-margin, sticky business that provides a consistent revenue stream. Any signs of a slowdown in these areas would be a major red flag, potentially shattering the growth narrative that is currently propping up the stock price. The macroeconomic environment will also play a massive role. If interest rates remain elevated, or if a recession looms, SoFi's lending portfolio could face pressure from increased delinquencies, and the stock could be hit hard. This is the biggest risk that the market is grappling with, and it is a key reason why the stock's valuation is so hotly debated. The opportunities, however, are just as significant. If SoFi can navigate these challenges, continue its march towards full, sustainable profitability, and prove that its diversified model can weather economic storms, the stock could still have significant upside. The market is not just buying a stock. It's buying into a vision of what finance will look like in the future. The question is, are they paying too much for that vision today? Comment below on what you think is a more significant risk for SoFi, a potential economic downturn or the threat of increasing competition from traditional banks and other fintechs. In conclusion, the story of SoFi is a microcosm of the modern market, a thrilling tug-of-war between retail momentum and institutional skepticism. The expectation is that the company's incredible growth will continue to drive its price to new heights. The reality, however, is that for all its operational success, the stock's valuation is stretched, and a deep-seated caution persists among professional investors. SoFi's journey from a niche student loan company to a financial super app is an impressive feat, but it is one that comes with a price tag that many believe has outpaced its current fundamental value. The coming quarters will reveal whether the company can bridge this gap and prove its doubters wrong, or if the gravity of its valuation will finally pull it back down to earth.